Good afternoon, everyone. This is Robert Rayburn here at Life Pro Asset Management. And I'm happy to say that today I'm joined by one of our great analysts on the team, Tim Devlin. Tim, say hi to the audience.
Hey everyone, nice to be here. Thanks for having me on, Rob.
Awesome. Well, everyone, I'm sure by now has noticed our format is a little bit different this week. So what we wanted to do was change things up. For many weeks over the last year and a half, we've been sending out the weekly updates in the version of slides where I have a voiceover. But what we really wanted to do is we'll be a little bit more interactive, not just in a video format where you can see ourselves, our faces, our interaction back and forth with different team members. But we also want to encourage a lot of our advisors and clients and prospects or just random viewers that watch our presentations on a weekly basis to submit questions throughout the week. We'll accumulate those questions and we'll answer them during our weekly updates. So without further ado, we're going to go ahead and get started. So I'm going to share my screen and Tim's going to confirm whether or not he can actually see the screen. This is our first dry run, so we do apologize ahead of time if there are any hiccups. Tim, can you see my screen?
I can.
Fantastic. So, really the theme of today's presentation is this return of Pax Americana. Over the last 12 years, the real theme has been to really exacerbate or to put on a pedestal this message of American decline. In other words, if we look at sort of the political instability that sort of racked the country over the last 12 years, and it's not just the last 4, but really kind of going back to the global financial crisis, this idea that the Western Hemisphere in general is in decline and that China's taking leadership and Russia's taking leadership, that's been something that has been a very fashionable message. And it's something that we don't agree with. It's something that when we look underneath the surface, we know that there's these core secular themes that have been taking hold over the last 10 years, but quietly so. What we think is going to happen here over the next 10 years in particular is going to be this roaring back of American technological leadership, a huge productivity boom that is about to take hold across the US and really will put America back at the forefront of not just economic leadership, but technological and innovative leadership. One thing that we're noticing is that innovation is accelerating. Whether we're talking about the cloud or we're talking about data analytics, artificial intelligence, we look at autonomous vehicles, right? All of these core giant themes are coming together and are really starting to play out in actual revenue producing business models here in the US. And when we think of those giant platforms that are leading the charge, there's one common denominator across all of these businesses. They are American, right? And so I think that's going to be something that is going to continue to play out, whether we're talking about established technology and consumer platforms such as Google and Facebook, or rising platforms. A lot of the businesses that we pay attention to. We don't like to invest in yesterday, we like to invest in tomorrow. So that's really sort of the core theme that we want to pay attention to, is that America's not in decline. That's typical in U.S. history, right? Whether we look at the Civil War, whether we look at World War II, the 1970s, America likes to kind of look down upon itself, but then just when everyone thinks it's down and out, we reaccelerate, and that's really what the 2020s are going to be all about when we look at our research and what that indicates. So 3 things that we want to pay attention to this week. Shorter term, we've had a nice, healthy pause in the stock market. That's normal. We think of the end of January, we had that quick 4 to 5% correction in the market, not even a technical correction, which is 10%. That allowed us to take some air, some froth out of the market before we resumed our move upward. It's good. This is healthy. Trust us on this. You want to see it. When asset prices move up and to the right in just one direction with no pause, that creates instability. We do not want instability. Secondly, we're going to dispel this myth that suddenly we're dealing with rising borrowing costs. Interest rates are shooting up. We've seen these headlines over the last 3 or 4 days. That's insane. We're going to go through the charts to kind of show that. And then, of course, we will round this up with sort of what we call successfully countering what we call investment communism. So many of our clients are converts from this decade-long migration toward passive investing in the index. Actually, there's nothing wrong with passive investing, but investing in the index. So zero regard for good companies, bad companies, mediocre companies, companies going from good to great, just investing in all of it. And what that does is that holds us back as investors, that holds us back as clients. When we invest in the stock market, we want to squeeze out the full potential. We want to partner with best of breed companies. We want to reward success. We want to punish failure. That's what America is about. That's what capitalism is about. And we want to move away from this idea that that merit plays no role in investing, right? We're a meritocracy. We're not a plutocracy. We're not a theocracy. We're a meritocracy. We want to reward merit. So that's really, at the end of the day, the 3 core things that we're going to focus on this week. I know Tim's got a couple great slides that he wants to talk about as it relates to overall asset allocation and the role of active investing. So we'll go ahead and move on here to the next slide. So Tim, can you see those performance numbers?
Yep, I can see them.
Awesome. So as of February 12th, what we see here is the tactical opportunity strategy is up just around 12.18%. Now, we've had about a 2 to 3% pullback here over the last, call it the last day or so. I think so around in live action right now as we're recording this, we're actually up closer to around 8.5, S&P 3.5. Nevertheless, having a nice, strong year-to-date move here very early in 2021. And when we talk about the market catching its breath, right now these performance numbers are a great, really kind of indicate that, because at the end of January, Tim, the year-to-date performance numbers at the end of January in 2021, we were up 1%. The market was down 1%, and then really midway through February, we're up 12%. So the market's had this real strong move upward after the whole GameStop fiasco, and now we need to take a breath. And when we look at the action day to day, I think today we were down 0.7, yesterday down 2. That is a healthy, nice reset after a 12% upward move in our strategy. When we look at that 1-year number, that 1-year number is really important, ladies and gentlemen, because it shows that we have been able to double client money over the course of the last 12 months. And of course, as we progress here over the next 3 or 4 weeks, we're going to, hopefully, knock on wood, we don't see anything like what we had last year. We should see that 1-year number expand as we start the lap comparisons of the market sell-off from a year ago. And it'll really kind of show the value of not just active investing, but taking advantage of irrational sell-offs when they do take place to buy best-of-breed companies that are deeply on sale. Lastly, of course, that since inception number up 267.52% versus 75% for the S&P 500. Whether we're talking in 2021, whether we're talking over the last year, or since inception, generating 192% outperformance versus that S&P 500 index. The question we always have for prospects, for existing clients and advisors is that, would you be willing to pay an extra 60 to 70 basis points over what we call those communist-based index investment products offer to get that type of performance? We think the answer is yes. We think that we've created that value and justify the extra 80 base or 0.8% in fees to, when we look at those performance results. We, of course, can never guarantee that. Are we going to have periods where we underperform? Of course we are. Are we going to have periods where we're down? Absolutely. But what we say to all new clients and existing clients is that we have no idea that when you first invest in our product, whether you'll make money over the next 3 or 4 weeks, whether you underperform or outperform, but give us 6 to 12 months. And I think you guys are going to be really, really happy. It can't guarantee it, of course, but give us 6 to 12 months. If we can't perform after that time period, fire us and move back towards those low-cost investment index products that we otherwise call sort of communist-based investment products that take zero regard to good or bad companies. This slide here is what we call sort of countering the red tide. So going back to that performance slide. So Tim, do you want to walk through really what this slide is telling our viewers?
Yeah, so kind of like you mentioned, whenever we look at new clients that are coming on, most of them have those low-cost index products, right? And what happens is
they're communist-based products. We want to really focus on that.
And what happens is, you're giving money to both good and bad areas of the market. And so one of the things Rob likes to walk clients through is, hey, we can probably do a better job for you just by avoiding the bad areas of the market. And so what we did here is we looked at all of the different companies within the S&P 500 index in 2020, and we looked to see how many of those companies actually outperformed the index. And so what I did here is I broke that down by the different sectors, the number of companies in those sectors, and then that percentage of outperformance. And what you'll notice here is sectors like energy, real estate, utilities have a very low rate of outperformance, right? And so these are, typically areas of the economy that last year we said, hey, we don't want to be in them. We want to avoid these areas. And just by doing that, you increase that potential for success, right? You don't have those bad areas that you're weighted to.
Yeah, it's what we call narrowing the field, ladies and gentlemen. What we want to be able to do is by simply shrinking the denominator, by knowing that, hey, if on a secular basis, we know that energy, the intensity of carbon-based energy is starting to decline, at least over the previous 4 to 5 years. That's been our view on energy. There is a bullish scenario that's starting to take place there, but in the past, that's been our view. By simply eliminating sectors we just simply don't want to be in, or areas within certain sectors. So if we think of the consumer sector, focusing on e-commerce versus the mall stocks, if we can do an effective job, as Tim mentioned, of sort of narrowing that field, the statistical chances of us selecting a good stock go up, right? It's simple math. And of course, we have to do a good job of narrowing the field. But the other thing I do want to point toward is look at the breadth of outperformance here across different sectors, right? It's not just in energy, it's across the board. Even in technology, only 67% outperform the S&P 500. And then you start to get just industrials, healthcare, basic materials. We're talking 40% and below in terms of the number of stocks that have outperformed. So in other words, the overall rate of outperformance, so stocks that have outperformed the S&P 500 is only about 36%. What this means is that when you invest $100,000 into an index product, at the end of the day, what you are doing is $64,000 of your money is going to companies that you would not otherwise invest in if you looked at them on a one-on-one basis. That's insane. That's investment communism. We are shifting money from people and companies that deserve it and reallocating it to companies that are destroying your wealth. We don't believe in that. That's anti-American. That's communism. That's not capitalism. We want to partner with best-of-breed firms. And I think this slide just does such a great job of illustrating that in an easy-to-understand way. So we talked about the markets, right? We need to catch our breath sometimes. So what we see here is the S&P 500 chart. Now, what I did not include, just so that it wasn't that noisy, is the moving averages, right? So when we think of short-term momentum, we know that markets are constantly in a cycle of downward or upward momentum. And like everything else that has momentum, we tend to overshoot and undershoot. Really, over the last 2 weeks after that GameStop sell-off, we had this upward accelerating momentum for the S&P 500, and probably sort of overshot that justification, really over the last few days. So now, similar to Marathon Runner, we have to catch our breath so we can continue to progress higher. So what I'm going to do here is I'm actually going to share my Bloomberg screen for all of our viewers so that they can actually kind of see what I'm talking about here for the S&P 500. Now, Tim, can you see my Bloomberg's chart?
Yep, I can see it.
Okay, so we're going to go ahead and get away from that Ethereum chart because that is not relevant to what we're talking about right now. But we're going to go ahead and we're going to view the S&P 500 chart. So what do we see here? A few moving averages. We got the 50, 100, 200-day moving average. So we see here at the very end of January, we had this nice, healthy 5% drop, and that pulled us right back into the overall 50-day moving average. Then the market reaccelerated. The gap between where the market was trading and the 50-day moving average got a little bit wide. And so really the last couple of days, we've started to stall out a little bit. Now, does that mean, Tim, that we always have to come back to the 50-day moving average? Absolutely not. There's two ways to work off an overbought condition. One is through price, and the other is through time. What we see here is we go back, November and December, we worked off that overbought condition through time. We just simply consolidated sideways, allowed sort of that momentum to die down until we got new buyers back into the market to reaccelerate that move upward. This also plays out at the individual stock level, right? So obviously one of our big winners last year was Peloton. It's one of our largest weights in the portfolio. What we see here is, again, very similar, sort of call that step ladder price pattern, where we get a nice reacceleration and then a reset, right? Again, that momentum plays out at the individual stock level. Has anything changed fundamentally in the story? Absolutely not. If anything, the recent earnings report shows that continued reacceleration in terms of new users coming onto the Peloton platform, very, very low churn rate. In other words, not only are the company attracting customers in a reopen or a shutdown type of environment, but those customers are staying. Right? You invest in a $2,000 bike, you're not just going to not use that after spending that type of money. Not only that, guess what? I don't know about you, ladies and gentlemen, but when I go to a gym and have to wait 30 minutes for every single machine because we have someone hogging that machine and it's sweaty and it's smelly, it's busy. I love just being able to go on my Peloton bike and be able to work out when and where that I want with my own level of privacy. And that's something that we continue to see on a secular basis. And the key with Peloton is the software, right? It's a software platform. It's not just about biking. It's about yoga. It's about cardio, about those classes and the level of instructors. So this is what we call a platform-based business model that we love. Software is infinitely scalable. We love that. So over the last couple of weeks and last couple of months, we've seen that consolidation back into that 100-day moving average. We love where it's sitting at right now. Could our day-to-day timing be off a little bit? Sure. But we're seeing that across the board with a number of our great franchises that we open. So if we look at Shopify recently reported numbers, again, we had this nice giant base. This is an example of, unlike Peloton, which corrected through price, Shopify has corrected through time, right? Nice reacceleration here as we saw more and more companies adopt e-commerce business platforms. Then we had to absorb the price action. Now we had this big, nice breakout upward and to the right. And of course, the market anticipating earnings, a classic buy the rumor, sell the news. We think that's a non-event. Of course, the earnings were fantastic. One of the fastest growing companies in the universe of stocks that we look at. And of course, check this out. This is a $170 billion company. When we look at Peloton, this is a $41 billion company. So when we look at our performance numbers, we are not investing in penny stocks. We are investing in real giant platforms that are in that process of going from good to great. Another example is Zoom, right? And it's a stock that we are often questioned on, but there is this idea that if the economy reopens, that no one's going to use Zoom anymore. Well, I got news, ladies and gentlemen. Look at the people behind me. Our office is fully reopened, and we use Zoom more than ever. In fact, we just started using a new iteration in terms of when we're going to be using Zoom, which is our weekly update. And the story I like to share is, we as a firm, we have these two events that we host every year called LifePro University, LifePro Summit. On a good year, we'll get 300 to 330 advisors that attend our event. We went towards Zoom webinar based over the last year because of COVID. We were able to get over 1,000 people to that event. Right? So think of the scale that occurs when you're able to implement an effective webinar model. More people, less expenses, right? You don't have to buy people booze. You don't have to, you don't have to get food, and you don't have to reserve the Hilton. All those expenses drop off, and you're able to engage a lot more people that wouldn't otherwise have traveled to your live event. Live events are important. But what this does is that it brings a more efficient business model. And we're seeing that across the board in corporate America, where a lot of those mid-level VPs no longer have to do those expensive business those business trips. They're able to do that via Zoom, and then sort of those higher level executives are more involved in sort of that person-to-person engagement. So again, we love where Zoom is right now. We've had that price action fall back down, and that's another correction through time. And then guess what? As the economy has started to reopen, guess what's working again? Zoom. Because we worked off that speculative froth, and now that stock is working upward and to the right. The last stock we'll sort of point out here for our viewers is AMD, another company that we absolutely love. We've owned it for many, many years, and big breakout, consolidated through price and time. And again, this is a classic example of a duopoly in the chip sector, an artificial intelligence leader through its GPU chips. And I would be shocked and surprised if this did not massively break out here over the next 12 to 16 months, 12 to 18 months, pardon me. It's just one of our favorite companies, and we just absolutely love it. But the point of these charts is to kind of show that you need consolidation. You need price action to reset itself once in a while. We see that in the best of breed companies across the stock market. You don't ever get just tick, 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 tick up and to the right. It's not sustainable. That's what ultimately creates a bubble, by the way, and leads to more volatility down the road. So overall, the price action is extremely healthy out there.
Now, Rob, you get on the call a lot with clients, and I know new clients coming on often have the question, why do I want to buy this stock? It's coming off its highs, kind of like you're talking about, going through that consolidation period. What are you coaching on them on? What are you telling them in regards to the portfolio as a whole?
Yeah, exactly. So, we never look at stocks on an, when we construct a portfolio, we don't want all the stocks to move up at the same time, right? So kind of going back to Zoom, right? So, and that's a great question, Tim. So if we see here, as other stocks have started to correct, like Peloton, what we see here now is Zoom is picking up the slack, right?
It looks like your Zoom chart isn't on here. Not sure if you're trying to show that.
Oh yeah, sorry. Let me bring that chart right back here for our viewers. All right, can you see the zoom there and my
Yep.
and you can
Now we
see
got
my,
it.
all right, awesome. So we see there is that as Peloton has pulled back, now Zoom is reaccelerating. And that's what's called proper portfolio construction and design. You don't want everything moving up at the same time. It's like a relay race. As one stock starts to tire out, the baton is passed off to another stock that can pull its weight. So we want to make sure that the portfolio is properly designed so that it can sustainably grow over and above the index through time. Otherwise, you get sort of this boom bust model with the portfolios, and that's where you can lose clients because certain clients, when they invest, are maybe coming in at a high point, they suddenly get a sharp punch to the gut. That's not proper portfolio design. We want sort of different themes that are working at different points in time that overall lead to a portfolio that can create sustainable outperformance through time. Does that answer your question there, Tim?
Yeah, definitely.
Awesome. Now, I think it's something that we see and we hear about often from clients. And the other question too, by the way, not to get off on too much of a tangent, is, well, I don't like to buy the market at the highs. It's the biggest mistake that we see investors make is to ignore strength, is to be scared of strength. Strength begets strength. If we look at the 2009 to 2019 bull market, 2012 new highs, 2013 new highs, 2014 new highs, 2015 new highs. You would have missed 80% of the bull market had you ignored the market because it was simply at a 52-week high. Apple was at a 52-week high in 2009, 2010, 2011, 2012, 2000, and so forth, right? Amazon, same story. At the end of the day, you got to look at the business. And you got to say, based on its market capitalization, based on the price that it's currently trading at, based on its forward growth rates over the next 5 years, do I think this business can double? And if you look at a stock and say, over 5 years, which is a pretty long time period, if you don't think that valuation can double or the market cap of that business can double over the next 5 years, it's probably not worth the volatility and the risk that you inherently buy when you buy a stock. Because all stocks are risky, by the way. And there's no such thing as a safe stock. And so what you need to do is have a diversified portfolio, not overdo it, own 20 to 30 great companies. And then each of those companies, you need to see a path to doubling over the next 5 years. That's how you create solid, healthy, attractive long-term growth. So I'm going to go ahead and reshare make sure I share the right slides here. All right. Do you see the reminder slide again?
Yep.
Awesome. So again, what we talked about here very short term again is that at the end of January, what we saw was that there was this mad rush for volatility, or what we sort of call portfolio protection. In other words, the demand for puts over calls. So when we sort of think of how do we protect portfolios, well, we would buy put options, right? That's one option that we have, mind the pun, of buying S&P 500 puts to offset the price decline in the portfolio. When you can buy options that expire front end, right? Or you can really buy S&P futures. So you would short S&P mini futures. And so when you look at the demand for front end protection versus say protection that expires in 6 months or 12 months, when people are massively clamoring for protection that's going to expire in a month, that shows that there is this irrational fear that has accumulated in the market. So if you think of your life insurance comparison, if someone said, I'm going to buy term life insurance that expires in a month versus term life insurance that expires in 10 years, that's kind of a red flag. I would say, well, what, you think you're going to die in the next month? It's sort of irrational. And the same thing plays out in the volatility market here, here in capital markets as well. So when you see this massive clamoring for short-term protection, it tends to be emblematic that things get washed out. And that's what we saw at the end of January. Now, something funny has happened since. The VIX has massively declined. And for the first time, what we're seeing is that the VIX has started to break below 20. And I cannot emphasize this enough. This is a structurally new pattern we're beginning to see in the volatility market. So I'm going to go ahead and share my Bloomberg screen again, because I think it's a very, very important point for our viewers. Now, Tim, can you see my screen again? Zoom,
Yep.
and you can see me typing. Oh, okay, here. So what I'm going to show here is the VIX. Now, the VIX on the surface here, you would say, okay, not that dramatic. Looks like we're at the bottom end of the range, right? But look what happens when I pull out over 5 years. This is a very important point, ladies and gentlemen. So what we see here is that for most of, I'm going to say, go back to even, gosh, say back to 2010. What we see here is that really the low end of the VIX, the low end of the trading pattern for VIX was around 10. Now, what happened after COVID was we had this dramatic freak out in the market where we spiked above 80. Then over the last year, as the market has rallied, the bottom end of the range has been 20. And that's been emblematic of a structurally higher level of uncertainty in the overall market. And when we started to break below 20 in the first part of February, I think it was very emblematic that we might, for the first time, be returning back to a more normalized volatility market. So in other words, a market where structural uncertainty is starting to compress. And that's also emblematic of this idea that Pax Americana is returning. The American peace, the American stability that we provide to the world. And as we break below these 20 levels, we do think that is a catalyst for a repricing for the overall stock market to move higher in 2020. And we can see that normalization, by the way, when we go back to our slide with the futures market. So we again see that VIX is no longer, investors are not clamoring for portfolio protection on the short end, but they're paying higher prices the longer in the future that we are, and that's called being normal. That's being rational, and that's something that we want to see. The other thing that's working for stocks is this concept of TINA. And of course, I'm not referring to my wife. My wife always gets a kick out of these presentations when she's forced by me to watch them because she would otherwise never watch them. She probably doesn't really watch them, let's be honest. But the concept of TINA, there is no alternative. And when we think right now of what the bond market is offering, well, the bond market is offering 0% to our viewers. And not only that, believe it or not, the US is the most attractive bond market at 1.3% 10-year yields. Think about how insane that is. We got inflation at 2% and the 10-year yields at 1.3, and that's actually considered the most attractive market in the world. Why? We got $16 trillion, $16 trillion of negative yielding interest rate bonds across the world in Europe and Japan. Now, if you're a pension fund manager, you're managing long-term liabilities, or a life insurance company managing long-term liabilities, and you say you have a choice. I can do a negative 0.5% 10-year bond Bund in Germany, or I can do a 1.3% positive yielding bond in the US. Guess what? I'm going to take the US and hedge my currency risk. And so, again, what's going on in the bond market is irrational, is insane. To accept a negative yielding instrument just makes absolutely no sense to us. And by the way, inflation has moved positive in Europe. So people are really getting punished over there in Europe. But what we wanted to show here is, again, stocks relative to bonds have started to break out. A picture says 1,000 words, right? We had the structural breakout in the bull market of 2009, 2010. We had that quick punch to the gut, and now we've broken out to new highs. This does not happen ahead of recessions, ladies and gentlemen. When we look at that 2008 sell-off, it started to deteriorate well ahead of that 2008 sell-off, well ahead. And what is the sign of a healthy bull market? stocks outperform bonds, even when bonds are, you have sort of low interest rates and bond prices are moving upward. The appetite for risk versus protection. We want to make sure that this is continuing. And so again, a positive symptom. We use that word symptom for a reason, Tim. You know why? And that is because that if you are looking to identify the next bear market by finding the exact cause of it, it's going to be very hard. It's like finding a needle in a haystack. But if you look for the symptoms that are common across many bear markets, you can perhaps get a clue. And one clue of a healthy bull market is that stocks outperform bonds.
Now, Rob, one of the things
Yeah.
you kind of pointed to there was that lack of yield in bonds.
Yeah.
What would you say to the other side of that coin, right? With rates rising, how is that affecting, those investors that might be looking for bonds?
That's a great question. So let's put things into perspective, ladies and gentlemen. We've heard over the last 2 weeks that interest rates have been moving up. Well, yes, but we've moved up to 1.3%. So in terms of the level of income that's being generated in the bond market, it's next to none. In fact, let's go back to our trusty Bloomberg terminal here and look at that 10-year yield. So what I want to show you, ladies and gentlemen, is how insane the media can be sometimes. So we've heard about this big rise in interest rates over the last week and a half. And that, by the way, has been sort of the precipitation of this sort of what we call a healthy pause in the stock market. Again, healthy pause in the stock market. What that means is we always look for an excuse to pull back, and the 10-year yield gave us that excuse. So let's look at what's really happened here over the last week. We've had this slow migration upward in interest rates. We bottomed out around 0.5. To our viewers, 0.5 is not a sign of health. We do want to move upward, but let's take a long-term chart here for a second. When the market was in a structural bull market, this is literally 12 months ago, we were sitting at 1.9% yields, okay? Today, if COVID had never happened, we would be sitting at record low interest rates today if COVID had never happened. Like let's take this back to 2008. This interest rates in 2008 during the depth of the global financial crisis were at 2%. We're sitting at 1.3%, ladies and gentlemen. So the idea that income is returning, the idea that bonds are massively selling is ridiculous. And so what we like to look at is what is the earnings yield relative to the bond yield. And when we take earnings yield that are being generated on stocks minus the bond yield, that spread is near record highs. And I think that's really what Tim was alluding to, is the fact that the relative attraction of stocks versus bonds is also near record highs when we look at actual valuation. And that's key, because at the end of the day, we have a choice as investors, right? We press our hand down on an air mattress, that air goes somewhere. And when things are not working out in one sector, that money is going to flow to the most attractive option. And right now, it's not attractive to hold cash. Why? Cash yields 0%. Cash is trash. When you have 2% inflation, you're losing 2% a year. Bonds, you at 1.3%, you're losing 0.7% on your money. By the way, this is why you see, and my Bloomberg chart's still up there, right, Tim?
Yep.
Right now, this is why you see Bitcoin doing what it's doing. People are looking for a proper hedge on their US dollar assets. I'm a holder of Bitcoin, right? I believe in it. But what is it really disrupting? It's not disrupting the US dollar, it's disrupting gold, right? So gold has often played this hedge of the US dollar. When we take a look at Bitcoin versus gold, gold is in a correction mode right now, right? We've seen gold dramatically underperform. And we think Bitcoin is actually playing the role of the disruptor in chief against gold. So we have to ask ourselves, What has typically moved gold? When you have negative interest rates or negative real rates, in other words, the level of interest rates are below where inflation is, that tends to be positive for gold. But it's not playing out in the gold market this time, it's playing out in the Bitcoin market. And that, ladies and gentlemen, is the difference of what's been taking place here in this market. People are losing money holding paper bond assets at the government bond level. It's called financial repression. We just basically fought a world war against a pandemic. We need to work off those debts. Governments pin interest rates below the rate of inflation as a tax on savers to work off their debt over time. We need to avoid this tax. How do we avoid this tax? Let's move over to where health is, where growth is, and that's the stock market. So I'm going to go back here to our trusty slides here and continue on. And again, to your point there, Tim, again, what we wanted to show here and just really kind of emphasize this is this is the long-term chart of the 10-year yield. Again, we're just back toward the panic point of last year. Right now, by the way, I think we're getting to a point where you actually will start to see the 10-year yield start to top out a little bit. Yes, the economy has bounced back and we think it will continue to do well. We think there's rigor in the recovery, but will it be a sustained 4, 5, 6% nominal growth recovery? Probably not. And you're going to start to see that reflected in interest rates because yes, we're having a recovery, but we're also not having China-like growth either. And I think you're going to start to see some short-term measures stall out here, and that'll sort of cap where we're at with interest rates. Now, this is an important chart, Tim, because what this really does show is that what's happening in the interest rate market is actually a measure of credit improvement by American consumers. Over the last couple of weeks, again, we've had the 10-year yield move up from 0.5 to 1.3%. But notice what mortgage rates aren't doing. Mortgage rates are not moving up. So while the 10-year yield has moved up, mortgage rates have stayed near record lows. Why is that? Because the balance sheet improvement of your average US consumer has improved. So the credit spreads have starting to compress across both the bond market and the consumer market. What this is a measure of what happened, by the way, notice what happened here, this little blip right here. That was because for a quick second there in March, the bond market or the mortgage market has said American consumers are becoming distressed. And so, yes, interest rates are falling, but we're going to charge more for mortgages because we think there's credit risk. Credit risk is collapsing across the US. American consumers are most flush with cash as they've been since post-World War II. I think a lot of people have lost the message where they pay attention to the unemployment rate at 7 to 10%, 800,000 jobless claims, and they don't. And similar to how a magician gets away with their tricks, they're paying attention to the magician and not paying attention to what's taking place to the left and right of the magician. And we need to pay attention to the 85 and 90% of Americans that are employed. Right? That's the key, that are employed. For those people, they've been able to make more income in 2020. Their expenditures have gone down 40%. Their savings rates have gone up to 45%, and they're flush with cash. And that's why you saw that consumer number yesterday, one of the best consumer numbers we've seen in many, many years outside of that initial reopen number in June and July. Credit, again, just looking at these credit spreads here in the US, as we talked about, credit spreads at record tight, right? So in other words, that level of implied credit risk in the US is continuing to fall. This is so fundamental, ladies and gentlemen, to our homework when we look at asset allocation. Why is that? Quite simply, we look at this because it's the foundation of capital markets in the US. We need to make sure that credit is able to flow from the suppliers of credit to those that demand credit. And when there's a blockage, you get something like 2008, right? Where credit cannot, it's like having a heart attack. You get the arteries get clogged through bad credit, and suddenly those spreads spike up. And businesses can't function, consumers can't function, they need credit. And so we always want to make sure that we're paying attention to that. So the fact that even through all of the hiccups of GameStop, the election, all that basic crap and distraction, what we've seen is credit spreads continue to tighten. That is a very, very healthy symptom. And then the one thing we would pay attention to is, for all this talk of the rise of China, credit spreads are actually starting to rise in China. Notice the dislocation between credit spreads in China versus the US. I don't know about you, Tim, but I'm going to stay long the US. I'm going to stay long capitalism. I'm going to stay long freedom. And I'm going to stay away from authoritarianism. I'm going to stay away from communism. And I'm going to stay away from an economy that has no basic way to diversify itself away from cronyism. And so again, we're long the US relative to China, we're short communism, we're long capitalism, and we encourage investors to do that as well when they think of passive index investing, which we think is very communist-based, versus a capitalist-based active investment approach that we really try to provide to our clients. The other chart here we want to show, and I know we're running a little bit long on time here, but is that America is starting to win the war against COVID. So for all of that negative press out there about COVID-19 and the vaccinations, America's getting its act together, and this is no different in history. When we look at World War II, we were caught flat-footed for the first really for the first 4 to 6 months. But you know what? The American machine is slow at first, and then as it reaccelerates, it gets faster and faster, and it's like that flywheel. And once it starts going, it can't be stopped. And we're seeing the same thing with vaccinations. Slow start, but now we have over 50 million Americans that have been vaccinated. 35 million Americans are known to have tested positive for COVID. So you're at 85 million Americans that have been either vaccinated or have the antibodies. And of course, we know that there's definitely millions of Americans out there that got COVID but never got tested. So right there, we know 100 million Americans at least or more have either been vaccinated, have the antibodies because at one point in time they had COVID. So what is happening as a result? Hospitalizations are collapsing. Daily mortality is collapsing. Case counts are collapsing. There's more people being vaccinated on a daily basis than getting COVID. So again, the news is good, ladies and gentlemen. The news is good. The news is positive. This is good for the economy. This is good for Americans. This is good for their families, and this is good for stocks. And then this chart we added, I think it's important. Secular growth matters. Notice what happened with a lot of the secular growth leaders in the technology sector when we had that downturn last year at this time. The margins of those businesses stayed above the prior expansionary peaks over the last 10 years. Think about that for a second. So we had businesses that, even though the economy was shut down, their margins were higher than their prior peaks in 2011 and in 2014 and 15. That is a sign of a defensible business model. Those are the types of businesses we like to invest in. What we don't like to invest in are these boom bust models, right? So these very cyclical types of businesses. We don't like to invest in those types of businesses because they're boom bust. They don't create equity value through time. We want to create businesses that are creating wealth for investors structurally through time. So you can buy a steel stock and make a quick 20, 30%, but be sure your timing's correct, because you'll immediately lose 20 to 30% if you don't get the timing correct. So, your steel stocks, your commodity stocks, your auto stocks, these tend to be these boom bust models. We prefer long-term quality secular growth. So as we wrap things up, ladies and gentlemen, the market continues to climb up that proverbial wall of worry. And in addition to that, there are increasing signs that innovation and productivity is starting to accelerate here in the US. It makes us excited as investors. We really think that the current period reminds us of the early 90s. And when we think of the current secular bull market, which was born in 2009, we think we're in the middle innings of a 20-year secular bull, interrupted by a cyclical bear market back in 2020. We're now in the second half of that secular bull, which is very similar to that 1980 to 2000 time period where we had the 1987 hiccup, then the second stretch, which was the most exciting, the most productive time in really in American history over the last 30 or 40 years, going back prior to the 1970s. We think we're in that stage again. And we know whether it's cloud computing, whether it's artificial intelligence, data analytics, autonomous vehicles, we know that there's so many things that are changing the way that Americans live that we can just see that productivity wanting to punch through upward and to the right. So we're extremely bullish right now. Is it natural to have 5 or 10% corrections on any given year? Absolutely, but pay attention to those companies. No signs of overheating. The Fed remains on the sidelines. Interest rates are low. Inflation is low. And of course, America is beginning to turn that battle against COVID. So thank you, everyone. Tim, thanks for joining us today. This is the first of many weekly updates. We'll be joined by Tim and other members of our team. So,
thanks
Tim,
for having me.
Yeah, absolutely. And I apologize, everyone. It was a little bit longer this week, but kind of a new format. We'll be shorter in the weeks ahead. And on behalf of Tim, myself, the rest of the Life Pro family, we want to thank all of our advisors and clients for all of their business. 2020 was such a strange year, and I cannot believe just how incredibly disciplined our clients are, how incredibly disciplined and loyal our advisors are. And it's been that discipline, that intelligence of our clients that has really allowed the results to play out. So thank you on behalf of all of us, and we'll see everyone again next week on Wednesday. Thank you. Oh, I do have to show the disclaimers. Otherwise, Scott will not be happy, our compliance officer. Thanks again, everyone.